Hi everybody in YouTube land. I am here in beautiful Puerto Rico doing a business conference to hopefully learn more to send you guys some great information about estate planning. But today we're going to talk about the dreaded taxes. Not the probate, which is normally the dreaded probate, but the dreaded taxes. It's that tax planning time of year. There's nothing certain in life except for death and taxes, as you all know. It is the time when we need to start thinking about getting those documents in order, whether you're getting a refund or tax preparation isn't part of the most thing as we do as an adult, but here we are. I always think of the movie Stranger Than Fiction and laugh in the scene when Joan Cusow's character throws Will Ferrell out of her bakery and shouts, "Get bent, tax man!" because everyone boos him because nobody likes taxes. But even though they're just doing their job, they work for the IRS and nobody likes them. So for today, just for clarity, this is not tax advice or legal advice in any way. I always say talk to your CPA, talk with a tax-related professional financial advisor when we're dealing with our taxes. But I also get a lot of questions on how does having a revocable living trust impact taxes? And the easy answer is it doesn't. The effect of a revocable living trust on a tax liability is interesting in a sense because it is a grantor, trustor, or settlor trust, if you will, and they retain the right to receive the trust income and principal because they're managing it through the trust just like they normally would with their assets. Just like you, if you didn't have a revocable living trust set up, you'd still pay your taxes in the same way as you do with the trust because it's a pass-through trust. Okay. So any income generated by a revocable trust is taxable to the trust creator, the trustor, who's going to then have to pay just as they would without that trust. That's because they're in full control of the trust, like I said, and they retain those assets and work with those assets normally, even if they didn't have the trust. Okay. The IRS views it as not a separate entity; it's one and the same. And so the income from that is not reported separately and instead is reported on the grantor's personal tax return. So the question becomes, does the trust need to file a tax return? And the answer to that is no. It's going to go through the personal taxes of the trustor. Because it's referred to as a grantor's trust, which is an agreement between the two individuals, usually the same person, the trustor and the trustee, managing those properties and those assets that are for the benefit of that trustor. Okay. The Internal Revenue website shows that the trustor has to correctly input the taxes on their normal form, their 1040, if they're the trustee. And the effect of this is the trust will not exist for tax purposes as long as it remains a grantor trust. Upon the death of the trustor or the surviving trust, the trust changes entirely and becomes an irrevocable trust at that point. So upon the death of that trustor or surviving trust, or if it's a joint marital trust, then the trust changes entirely and becomes an irrevocable trust that locks down at that point. The trust then changes to an irrevocable trust, not a revocable trust as they had originally set it up. And in order to preserve the wishes of the trustor, that's why it's locked down, so nobody is coming in and changing it at that point. So basically, once the trustor has passed away, their rights over the trust and properties automatically transfers to the beneficiaries at that point. So for proper distribution, the trustee specified in the trust documents gets all the power and rights of the trustor to use to possess, if you will. The trustee might be one of the beneficiaries. Typically, oftentimes they are. So the revocable trust taxes will then be known as an irrevocable trust tax, and there are kinds of taxes that are required to be filed upon that happening. I always say, again, talk with your CPA. So at that point, when the trust locks down and becomes irrevocable at the passing of that trustor or surviving trustor, typically you'd go and get an EIN for identifying purposes with the IRS. So that is a free tax number, or it's basically the social security number of an entity. Don't let any agency or anything charge you for that. It's free from the IRS website. So make sure you're at the irs.gov website and applying for that EIN number. Okay. Then you're going to ascertain whether the trust has earned more than $600 that tax year. You're going to visit that IRS website again to download that 1041 form and the Schedule K for the beneficiaries to show amounts distributed to them. Then you're going to confirm the K1 is the correct one, as there are different versions. Report all the income directly to the IRS, related to the property. Report all profits and losses and deductions from the owner, and fill in that K1 and 1041 and give copies to the beneficiaries and then send to the IRS. Like I said, I don't deal with numbers. I don't do any of that. I have my accountant do it. You should too. There's a really great article in Forbes recently about helpful tax planning tips for your personal taxes that can help you minimize your tax liability and make most of your money. And I'll link that in the show notes. It's Forbes.com /advisor/taxes, tax prep checklist. And some highlights of that are really informative and helpful that I thought were, maximizing your deductions, making sure you take advantage of all the deductions you're eligible for, such as mortgage interest, charitable donations, and business expenses if you have those. Contributing to your retirement accounts, certain retirement accounts such as 401ks or traditional IRAs may be tax deductible, which can lower your tax income. And then consider tax efficient investments. Some investments such as municipal bonds may provide tax-free income, while others like exchange trade funds may be more tax efficient than others. Again, always check with your CPA. And make use of those tax credits. They're there for a reason. They can reduce your tax liability dollar for dollar, which is great. And it's good for you to be aware of those. So pretty much I always say check with your tax advisor, check with your CPA, your financial advisor, making sure that everything is on the up and up. Those people deal with this every day. Frankly, nobody wants to read the tax code, but CPAs are required to and do. So I always say, pay them what they're worth. So good luck on that. If you found value in this, please subscribe and like for more information. And to make your estate planning journey a little less overwhelming, you can download our free estate planning workbook to help you answer those tough questions. And then when you get that done, you can visit our specially designed templates and your signature package called Your Estate Plan to get you and your family fully set up. So you can find all that at highsierralegal.com. And as always, this is not any legal advice. I went to law school, so you don't have to, but I'm not a practicing attorney and I'm not your attorney. I'm not offering any legal advice or any content in this episode that is any kind of legal advice. So all content is for informational and educational purposes. It's not a substitute for seeking your own legal advice from your attorney or any other professional such as a CPA or financial advisor. I cannot give legal advice and I do not offer any legal advice or services, but I do offer funny and educational information to help estate planning a little less scary for you. So again, check me out on highsierralegal.com or Instagram at highsierralegal or Facebook as well. So hope you guys find information helpful in this episode for your tax planning journey, and I'll see you guys soon.